joined today by Ben Crawford, the CEO of CentralNic. CentralNic is a leading global domain name services and online marketing business operating through two divisions. Firstly, online presence, which provides businesses with services including domain names, hosting, websites, email security, certification, and brand protection. And secondly, online marketing, built around the Team Internet business acquired in 2019. Which helps domain name owners monetize online traffic using an anonymized, privacy-protected marketing platform. Ben, would you be kind enough to briefly introduce yourself and CentralNic?
Happy to. Thank you, Richard. So I'm Ben Crawford. I've been the CEO of CentralNic for 12 years. We IPO'd on the AIM market of the London Stock Exchange 8 years ago. And over that time, we've increased our revenues from around $3 million to around $350 million. As you said, we provide companies with the tools they need to do business online, both online presence tools and the online marketing tools they need to acquire customers and generate revenues.
We've mentioned CentralNic's two divisions, online presence and online marketing. Are these standalone businesses, or how do they sort of interact with each other?
Sure. So we acquired the online marketing businesses over the last 2 years. So they came with their own customers, and today we can cross-sell between their customers and the customers of our legacy online presence businesses. But we've found some even more exciting synergies. The online marketing businesses are very advanced in data science and AI. So now we're porting that expertise over to optimize our online presence segment as well.
And to dig a little deeper into online marketing, could you explain why online marketing is performing so strongly and why you have few concerns about the increasing privacy initiative being brought in by Apple and Google, I suppose, particularly, amongst others?
Understood. Well, the online marketing sector as a whole is growing at north of 20% a year. And our companies are leaders in the niches that are too small for the giants to compete in, but still have huge potential for growth for us. We're innovators and patent holders with great technology that delivers superior return on investment to our customers, which means our customers are giving us more business and we're winning more and more customers. And as you say, we expect more regulation and policy changes from the big platforms to help us, as all our marketing solutions are privacy friendly. They don't use cookies and they don't collect private data on customers.
That's a great place to be. Well, CentralNic has been built around hosting and related web services historically, with comparators including GoDaddy and VeriSign in the US and R22 in Poland. However, in the first half, online marketing for the first time represented the majority, 55% of total revenues, and has been growing faster than online presence over the past few quarters and halves. With few direct comparators, how should we think about the shape of CentralNic in the future? And which businesses do you consider to be most comparable to CentralNic?
Well, on the London Stock Exchange, I'd say that Tremor and Dot Digital would be good comparators to our digital marketing businesses. And based on our organic growth rates, the weighting towards online marketing will clearly continue to grow. However, our online marketing presence segment is also growing today at double the historical levels that it used to, and it will continue to be bigger and faster growing than it's ever been before, and just as resilient. That online presence business that is amazingly sticky, with only 2% of customers switching suppliers either away from us, but actually more than 2% switching to us each year.
Well, delighted to have introduced growth there, because CentralNic has got some very impressive growth statistics historically. with a compound annual growth rate of 78%, I think, between FY15, financial year 15 and 20, and our estimate for current year growth of 45%. If I recall, you also delivered 20% year-on-year organic growth in the first half results, 16% in Q1, accelerating to 25% in Q2, driven by heightened investment in H2 20 and second half of 2020 and the first half of 2021. Could you talk a little bit more about this investment in systems and people, and looking ahead, how sustainable do you see these levels of growth?
Well, the growth levels are very sustainable, as they largely reflect changes to our company rather than changes in the market. So firstly, we acquired the online marketing companies, and that sector typically enjoys a stronger rate of growth than online presence companies. But we also made some very important structural changes to the online presence business as well. If we go back 2 years, we had a very small head office function and relatively autonomous subsidiary companies. And then at the beginning of last year, we decided to change that significantly. This included a significant investment in new hires and new systems. But what we did is we built out our head office function to a much more robust finance function, HR function, in-house legal function, and a project office and a product office. And we rolled out over the entire company various software platforms like Salesforce, G Suite, Zendesk, and Jira to be common tools across our group. And then when it came to the leadership of our businesses, for many of them, we actually changed the leadership to people who were more commercially focused, and essentially hired them with the requirement that they deliver the greater organic growth than we'd received historically. And under those leadership, we gave them more authority to integrate the businesses together. And so as an example, we can use the group's buying power to achieve lower prices from some of our suppliers, pass those lower prices on to our customers, and make us more price competitive, allowing us to grow faster. So a lot of changes, but essentially the investments that we made during the course of last year, which indeed obviously continue as they're largely staff and systems, have more than paid off. We invested around $9 million on an annualized basis, and our revenues were up 29 million H1 this year over H1 last year.
And if I recall, you've just hired a new somebody from GoDaddy, so a new senior hire from GoDaddy.
We have. So this is our new Chief Technology and Product Officer, Carsten Surov, who was until last week the CIO of GoDaddy, the largest retailer in our industry. And we're delighted to have Carsten join us. Among his real proven strengths over the years are technical integrations of companies. He was, before GoDaddy, the CTO of Host Europe Group, which, as I recall, made about 22 acquisitions, which he then integrated technically. And also, he's a real expert on products and services that we don't have at the moment. So really bringing a fantastic skill set into our leadership team.
Well, that sounds like an excellent hire. So many congratulations on that. In the first half results, you also talked about CentralNic benefiting from operating leverage in future periods as the business scales. Could you explain what this means and how it will benefit the business and, I suppose, investors?
Yes, absolutely. So CentralNic's essentially a platform business, and so whilst we did increase our overhead expenses over the course of the last year, as I explained, to really build out a much more robust functions, that spending is tapering off at the moment, will plateau, but we expect the revenues to continue to grow. In other words, as we move forward, for the margins to increase. And when we look over at peers of ours that are significantly larger than us, you will see that their EBITDA margins are higher than ours. So we're not just predicting something that hasn't been seen before. Actually, it's a common pattern in our industry for scale to improve those EBITDA margins.
The first half has again been quite a quiet period for M&A. So coming back to the M&A theme, after busy years in sort of 2019 and 2020, as buy and build remains an integral part of your growth strategy, what sizes and types of deal should investors expect looking ahead?
Well, we did actually have already made 2 acquisitions this year, but they are smaller. We are seeing
relatively quiet, yes.
Yeah. So some opportunity, a rich seam of opportunities for smaller acquisitions to bolt onto our businesses, either to just extend their reach geographically, extend their product suite, or indeed just sometimes adding 2 businesses together can actually just improve both of them. And we've actually already seen that happen this year. So I think investors can expect a steady stream of these smaller acquisitions. Larger acquisitions, we would love, in a deal to be able to add, $5, 10, $20 million to our EBITDA. Obviously, that's something we would absolutely love to see. They're harder to get because we are value buyers. We're not in the business of entering auctions and being the highest bidder up against PE funds or our peers that are rated at 25 times EBITDA on NASDAQ. So it's harder for us to get those targets, but if we can, we will. But you could expect that to happen much less than the smaller bolt-ons.
Okay, so you will continue to be very selective and
always
and targeted in terms of the investments you're looking for.
Yeah, I mean, it's worth adding that we're incredibly selective, not just on ensuring that the deals are earnings accretive, but that they match exactly the same investment criteria that investors love in us: recurring revenues, super high cash conversions, stickiness of customers. And so we won't be buying businesses that don't fit in with exactly those criteria.
Brilliant. Well, Ben, thank you very much indeed. So Ben Crawford, CEO of CentralNic, thank you for your time.
Thank you, Richard.